I'm going to just connect with Mr. DP Singh, Deputy Managing Director and Chief of Business Officer with SBI Mutual Funds. SBI Mutual Fund is now the biggest mutual fund in India. The size at which they are growing, it is a clear indication of strategy, product launches, and also advantage of the brand and branch and the brand they have. Mr. Singh, last time when we spoke to you, you gave us a tall number in terms of where the size of SBI AMC would be. We argued that how will you achieve it? But you're on course to almost double it.
Yeah. Yeah, thank you. Thank you. I think we set out a number and we are already 40% above that. And from here on, if we do another 40%, we'll be achieving the number which we committed to you.
Growth coming from small towns, more players from existing who are increasing their exposure. Where is the growth coming from?
The growth is coming from all across. See, we never think that we are the market sharers. We are the market makers. We are creating market. We are leading with great margin in the smaller towns, B30, what you call it. And top 30 also, we are increasing our market share. We are getting more and more number of new customers into the market, thanks to the parent who are having a foothold in across the country. And when we look at our data, when we see that we are getting business from 94-95% of the pin codes of the country, that gives us a lot of solace. So it's Bharat which is getting us money. We are serving everybody, every niche in the investment arena is with us. Maybe it ultra HNI or HNI or a retail investor or a small trader or a laborer. So we were getting when SIPs from 500 rupees to 5 lakh rupees. So that is the kind of numbers we are getting. So we are very happy and satisfied with the kind of numbers and with the quality of numbers rather, with the numbers per se, but the quality of numbers is very good.
Coming up with two new equity index funds, mid cap and small cap. Up until now, the index funds are largely large benchmark dominated. For example, Nifty 50 or Bank Nifty. Why are you coming out with the index fund for mid and small cap?
See, there are two. One is on the active side, we have to pick up the stocks which we feel the universe is very limited for us, which we can follow. And see, then again, there's a capacity constraint, there's a liquidity constraint. So we thought, in addition to the small cap active fund which we are having, and we have a constraint of getting lump sum money, so we thought of coming out with the small cap 250 index, where somebody, when one thing is very clear, that small cap index is outperforming and hopefully will continue to outperform the normal benchmark which you talk about, Nifty 50 or banking, etc. Because more and more new businesses are coming, very good management companies are coming. They are coming out with the new ideas, new set of businesses are growing. So this Nifty next, small cap index will give us a leeway that we can get money. Anybody who wants to take a call on the small cap per se, they can get into this without any limitation of the amount. And second, see, liquidity will be easier here. That there will always be some liquid stocks. So in case of any redemption or something, that will not be a problem. So this is very good and very cost effective as well.
Just to understand the structure here, these are index funds, which means I'm assuming that the charge here would be significantly less than what you actually charge in active schemes?
Yeah, it will be lesser than that. It significantly lesser, definitely, but it will not be like the Nifty 50 or Sensex ETFs, because here the cost of acquisition plus then of course the tracking error will be much more than those, because those are mirroring 100%. Here, if we are having a little higher tracking error also, that's fine. But yes, since these are to be intermediated, there has to be, you have to take care of all the stakeholders, because in our business there are three stakeholders: manufacturer, the distributor, and the investor. So it has to be win-win for all the three. because there's an acquisition cost involved. People have to advise, people have to intermediate. Anyhow, for the regular, for the direct plan, the cost will be very, very significantly lower than the normal one.
So if one has to choose between a mid-cap actively managed fund versus a mid-cap index fund, what is a better idea? Because you have both the products.
No, both have their own pros and cons. See, in the active fund, the whole hog research went into within the mid cap stocks. We do research on the stocks, and we visit companies. We have a very, very close interaction with the management teams. We follow the businesses being done by the company. There's a lot of efforts which goes into an active fund. The whereas in the passive fund, we just have a universe and you have to put it there, period. So the efforts are less, so the cost is also less, but you get the benefit of the overall, because we can't say that whatever our universe will continue to be the best performing. Because for now, if we have got 300 to 400 stocks which are in our universe in the active side, we can't really claim that these are the best of the whole company. And there could be some companies which may give very good results. But if you are in an index fund, you'll get the benefit of the growth in those as well. So both have their own pros and cons. I think it has to be a hybrid, active and passive both. And if I have got 100 rupees, I will definitely like to put 20 to 30 rupees in the passives and remaining in actives as of now.
One looks at, let's say, a very simple way of diversification. Can I say that buy one Nifty ETF, one mid cap and one small cap, and large part of your diversification in equity market is taken care of? And is that the thought behind these two new NFOs?
See, generalizing this statement is very, very difficult because, of course, we are of a very firm opinion that alpha generating stocks are still there in the market, which are to be researched, which are to be there. Active will continue to grow at least for next 5 years to 10 years. The kind of new businesses which are coming, which need to be researched. So we don't want people to be caught and something which is not being properly researched. So there's a space for both to continue. Yes, what you are talking about, large Nifty, Sensex, and mid cap, whatever passive portion in my allocation is there. Yes, if you do that, that is clear. But as I said earlier, if I got 100 rupees, I will allocate 30 to 40 rupees overall into the passives. Remaining, I will keep it in the actives only, because I still firmly believe that active will continue to give outperform the index funds.
Because saying globally, a lot of chatter is on that index investing is the best and the cheapest way to create long-term wealth. But in India, it's different. ETFs are not that popular, they are not that large, and active funds have done a reasonable job if you look at a long cycle of meeting the benchmark. So do you think that is something which needs to be understood, that while index fund is important, but active schemes also have a long, long way to go?
Yeah, that's there, because see, the is the in the cycle, in the growth of the economy where we are as a moment, when there are so many new businesses are coming, and we need to research those companies. When the new age companies are coming, we need to research them and see what is good, what is not good, what can give much better returns than the index. So that capability and that see possibility is very much there in the economic cycle where we are today. And second is this, our benchmarks are a little skewed. Like we have got one side, we have got only 50 stocks, and the others we have only 30 stocks, which are the main stocks are there. If you look at the US, the S&P 500, there are 500 stocks in that. So that covers a lot of things. And today, whenever, especially our market is also driven by FIA and FPI flows, and whenever somebody comes from outside, they first buy the main, the flagship say index funds or black flagship ETFs. So they get into these 50 stocks or 30 stocks. So the lot of money automatically comes into these stocks. But whereas the universe is too big, more than 7,000 listed companies are there. But the main benchmarks are only 50 companies, top 50 companies or top 100 companies. So there is so much room in the remaining, other than these 100 companies, and definitely a lot of research is required. Things are moving towards that when we get more money into the index funds, and that is why today we are launching the five passive funds, all put together, three on the debt side and two on the equity side. So that's the thought process is that only that there will be a space, people will, more and more people will get into the index funds. That's why we are making it available to the citizens of the country.
All right, Mr. Singh, really appreciate your time and so glad you could join us. Good luck with the new schemes.
Thank you, Nikunj. Thank you very much.